Okay, well, as some of the other people join in, let's just take a minute here. We're so happy that you're here with us in talking about this discussion. It's been a crazy 12 months in the markets, and so we thought it would be timely to have a discussion about how to invest in turbulent markets. So what we're going to be talking about today, first off, we're gonna let Joy give us a great introduction to Kempton Asset Management. And I'm gonna jump in just after her and talk about the basics of financial planning and what every investor needs to know about having an investment portfolio. And then finally, we're going to end at the end of the session talking about diversification and the importance of diversification in your portfolio. So my name is Shannon Gothard Ramirez. I am Canadian, but I've been living in Mexico City for approximately the last 25 years off and on. I'm a partner here at Kempton Asset Management, and I have been a financial advisor for the last 20 years. So I've had the privilege of working with many families and helping them save and build their wealth over a number of years. In the office, so something interesting about me. In the office, I'm known as the baker. I'm the one that builds the things that have carbs in them. It's the comfort food. I guess I'm like the mom in the office, and I have a great office. And so one of my partners here is Joy. Joy, why don't you introduce yourself?
Yeah, thanks, Shannon, and welcome everybody. Your cookies are amazing, and what you say, you're like my Mexican mom, because I'm from the Netherlands. I've been living and working in Mexico for 3 years. I have a bachelor's degree in business administration from the Rotterdam University. I'm a senior advisor at Kempton. What I love most about working at Kempton is working closely with my clients, building personal relationships, starting their financial journey. And well, a fun fact about me is that I love doing CrossFit. I'm very fanatic, I'm very competitive as well, and I love it very much. I do it every day. So let's just go into a short introduction to Kempton. A lot of people might already know about Kempton. Kempton is a British financial broker. We have been here in Mexico since 2013. Now, we're the largest independent global financial broker in Mexico, and we're the third one in Latin America. We work with different international banking partners outside of Mexico. We have a very diverse and dedicated team. And as a team, we have expertise in portfolio management, educational planning, and retirement planning. And as a firm, we manage over $100 million in assets under administration, and we have over 1,000 clients in Latin America. I'll give the word back to you, Shannon.
Thanks a lot. Okay, so let's jump right in. This is a scary, scary slide to most people that don't work in financial markets. And basically what it shows us is a bull and bear market, its historical trends, and its impact on portfolios. So what does it mean? If you look at the dates here and you see some of the things, so this goes back to like August of last year, 2020, when we were in the midst of the start of coronavirus. And that's where we had the breakdown in the market. But prior to that, we had had a positive market for many years. It was almost the longest run. And in 2008, we had the financial crisis. Some of us that are logged in will remember Iraq wars, the tech bubble. This goes all the way back to 1970. So you can see the up and the down in the market. And why is it important to kind of look back? Because I think looking back gives us comfort. What I'm going to talk about, it gives us comfort. So right now we're in the middle of COVID, the pandemic, and it's still wreaking havoc on global markets. It's leaving investors just wondering how long this roller coaster is going to last and whether or not they should stay on the roller coaster or get off. You know, even the investors that we see that have traditionally made the right moves in their investing, like investing for long terms, keeping their portfolios diversified, they're still feeling alarmed. And it's really unprecedented times because this is a global pandemic. We've never seen anything in our lifetime like this. It's normal to feel scared. It's normal to have fear. And I think what's causing more fear is the fact that we're isolated, we're home, we're not out having lunch with our friends and talking about it and thinking of solutions together. We're typically dealing with this, you know, and sleeping at night just thinking about our jobs and our families. And we don't have anybody to talk to like normal. So it's important to remember that just like in the past, the markets recovered, they will again. And markets typically experience a 10 to 20% correction roughly every 1 or 2 years. Now, those corrections are little moderate. They're moderate corrections. They don't cause too much damage, but they do indeed happen. And so it's important to not overreact. And remember that even when we had the Spanish flu back in 1918, we didn't lose global markets. So instead of taking knee-jerk reactions, we suggest to our investors that they consider their long-term plans, that they take deliberate steps that can further their long-term investments. And, you know, it's important to state this, that, you know, we can't control the markets. It's obvious. I mean, this example of this chart shows us that. But as investors, we aren't completely powerless. There's things that we can do to strengthen our financial health, even in downturns. So what we're going to do today is we're going to focus on the plan. We're not going to talk about the market so much. We're not going to talk about strategies that can jeopardize your long-term strategy. We're not going to be fearful. And what we're going to do is we're just going to reflect on your tolerance as the investor, what your time horizon is, you know, what are your financial goals? And we're going to, in the future, take relevant adjustments over time so that you have the ability to not be scared by the headlines. So let's get started. So what's the first thing that we typically do when we're working with clients? We put together a plan. You know, very rarely do we go on a trip without buying a plane ticket, booking the hotel, and setting the date of time, you know, the amount of time that we're going to travel. It's the same thing with a financial plan. We want to set goals. So goals are typically 3 types of goals. We have short-term goals, we have medium-term goals, and we have long-term goals. So short-term are usually 6 months to 5 years. Medium is 5 to 10 years, and long-term goal is anything over 10 years. So that could be education, it could be retirement. Typically, those are the expensive goals. So things that we have to consider. We have to create a budget. So the first thing that we look at is cash flow. You know, what is your income? And then what are your fixed expenses? So what is your rent? What is your mortgage? What is your healthcare? What's your transportation? What's the cost of education that you have for kids? And what's your debt? So the very next thing that we do is we look at where you're spending your money. Discretionary spending or discretionary expenses like dining out or gifts, clothes, entertainment, anything that is a want and not a need, as we mentioned in our last webinar. So discretionary spending, I don't know about you, Joy, but last year for me, I saved more money last year because I wasn't going out to restaurants. I wasn't buying suits for the office. I didn't buy shoes, you know, I wasn't traveling. So I actually was able to have a little bit more money in my bank account. And that's important. Last year and this year, we're still in it. We have had a very bumpy year economically. At home, we've all felt it at home. So a very important savings component that we always suggest is building your emergency fund. So an emergency fund is typically about 3 months to 1 year of your income. And it's exactly what it sounds like. It's an emergency fund that protects you from those curveballs that life sends you. Could protect from unemployment or a health circumstance. And it's really important to have, because best laid financial plans, your goals for your medium and long-term goals, can be taken off track if we don't have this type of a fund. So when we talk about financial planning, there's lots of calculations that go into building a plan. And sometimes clients feel like they can do it on their own, but then there's other people that don't feel comfortable doing it on their own and they need some professional advice. So we always recommend that you speak to a financial planner, somebody that can help you calculate those numbers so that you're not setting the wrong amount of money for the goal. And one of the calculations that we do regularly, I mentioned we work with families, we have families. And so this is one of the calculations that we do, and it's common, equally as common as a retirement calculation. So I'm a mom. I have 2 boys, and my kids are well into the university stage. So I'm past this, but this is an example that I want to give you. Let's pretend I have a daughter, Daniela, and I have a son, Emilio. Daniela's 6 and Emilio's 10. And I want them to go to university. I went to university and I want them to have a great university education. So I do live in Mexico. My life is here. So it's pretty much, my understanding that they'll probably go to school here. So a 4-year education here in Mexico in Tech, Ibero, or Anáhuac has a cost currently of about $60,000 US for that 4-year licenciatura. So Daniela is not ready to go to school, but I know that I have to factor in the cost of inflation. Inflation for for school here in Mexico is at about 7.5%. So it's actually going to cost me about $143,000 to send Daniela to school, which is a crazy amount of money. And for Emilio, he's going to go to school in 8 years. It's a little bit less, about $107,000. So I need to have set aside for these 2 children of about $250,000 US dollars. So you can see why it's important to have a goal to save for it, because most of us don't have this kind of cash just sitting around. It's something that we definitely need to plan for. Once you have the plan, what do we do next? So, when we review plans, we typically review them yearly. And we also review them when there's a big life change. So what's a big life change? Like significant income change. It could be a job change. It could be a change in your family dynamics, a new baby, and adopting a baby, getting married, getting divorced, or losing your partner. And it could also just be something as simple as, buying or selling your house, receiving an inheritance, or having unexpected debt. Any change that is a major lifestyle change can have obviously a fairly negative or positive effect on your goals. So it's important to review. The plan always needs to review also to look for new market opportunities. And so one of the next things that we're going to talk about, and Joy's going to walk us through this, is when you have your financial plan and you know how much money you want to set aside for your goals, how do you create the investment portfolio that's going to protect you from turbulent times?
Thank you, Shannon. So where to need actually start once you have a financial plan? Oh, let me go back. Yes. So one thing I want to mention before is whether you're 30 years old, whether you're 45 years old, it's never too early to get started. And so the first thing to do is to look for help. Like, we get it. You're busy, you have a family, you have a full-time job. And moreover, this is not your field of expertise. And that's totally fine. You can build your portfolio or you can start it on your own. No problem. But a lot of people don't have the time to track the markets and to manage their portfolio. And so look for help. Sit down with a financial advisor. Start a journey with an expert. Like, I always like to say to my clients, like, we're in this together. Like, you're not alone. And as Shannon mentioned before, like, define your goals. Make sure you have your short, medium, and long-term goals ready and have the amount set. So if you're unsure about that, have a talk with your advisor and see what kind of goal is for you. Choose an account that works best for you and choose an account that works towards your goals. Now, in the market, we see 2 types of different accounts. One account is for those people who want to save on a regular basis. So a regular saving account might work for those that have a regular income, they have a quarterly bonus, or they have a regular salary. It's kind of an account for those people that want to have a set it, forget it mindset. So it's automatic savings that go directly from your account here in Mexico or wherever your money is managed to your account with the new bank. The other type of account that we see in the markets is a lump sum contributed account or a lump sum portfolio. Now, some people might already have accumulated wealth or money here in Mexico, or I mean, wherever you are, right? So wherever you are and you have already accumulated that wealth, that money, you might want to send it to a strong currency, what Shannon talked about earlier. You might want to put it to work. You might want it to send it to another jurisdiction, a much more safer jurisdiction. And so whether you're looking for a short-term, medium-term, or long-term account, whether a regular savings account works for you or a lump sum contributed account, it's essential for you to find the right type of account. And so once you've chosen the account that works for you, like understand your tolerance to risk. So your tolerance to risk is basically your willingness to see your account going up and down in value. It simply said a healthy balance versus risk versus reward. And just as Shannon mentioned, like this is not something that's permanently defined. Like this is something that changes after a big life event, such as getting married, such as getting babies. It changes by age. So for example, if you're 30 years old, you might have another tolerance to risk than when you're 50 years old and maybe closer to retiring. It also might change after you have a change in income. It might change after your knowledge of investments and also with timing. So when you're going to need the money. So once you've understood your tolerance to risk as well, you are ready to go. Like a financial advisor can help to set you up the best asset allocation for you. Best asset allocation, your strategy, your investment strategy. Like it's basically a simple pool. It's a simple pool of different investment instruments in your portfolio. And so let's take a step back. Let's try to simplify this. Like your account, that's the vehicle. The account is the car. And the investment instruments, they're the individual components. And so during normal market conditions, we pick up and drop off different individual components, different investment instruments. But during a turbulent market, we stay in the car. We don't do drop-offs. We don't do pickups. We stay consistent. It's like driving on a highway. Like if you drive on a highway, you're not going to stop. Like it's too risky to stop. Also, if you already have an account and you don't know if it's updated or you're not sure about your tolerance to risk anymore, make sure to rebalance your account. Make sure to review your account with your advisor. So I have put together examples of different investors in the markets. Investors like a conservative investor, a balanced investor, and an aggressive investor. And so let's take a look at Monica, Juan, and Jose. So Monica, she's a conservative investor. Monica, she's 59 years old. She's 6 years close to retiring. She wants to retire when she's 65. She has a husband, 2 grown-up children, and Monica has saved all her life. Monica knows that the amount that she has saved, she wants to use that for her retirement. And so she doesn't want to put her capital at risk. She knows that this money, she's going to use that to retire at the beach. Monica, she's invested in low risk instruments. So she's invested in bonds and she is invested in metals such as gold. Like Monica, she's not looking for high returns. Monica's looking for a slow but steady and safe investment. Mm-hmm. Now, Juan is a balanced investor. Juan is 45 years old. He started quite late investing, we would say. Juan has 3 young children. He wants to send them to a top university in Mexico, just as Shannon talked about, Tec de Monterrey, ANUAC. And so Juan started quite late, and he knows that he needs to be a little bit more aggressive because he should have started earlier. So Juan has a mix of both low risk instruments and high risk instruments. So he's invested in bonds and he's invested in equities as well. Now, Jose is a young professional. Jose is a lawyer. He's 30 years old. He's very successful. He's very smart. He's single, no commitments. He makes a lot of money. Jose is an aggressive investor. Jose likes high returns. And so he understands that his account can go up and down in value, but he's okay with that because he knows that he's going to be in different kind of markets, investment cycles and different market cycles prior to his retirement. He knows he's going to have a lot of time in the markets. And Jose likes to be in the markets, like he likes to look for new opportunities. He's invested in stocks, he's invested in equities, in technology companies. So he's a very high risk profile. So Shannon, I'm going to give the word back to you. You'll be talking a little bit more in depth about the different kind of investment instruments.
That's right. Okay, so Joy just used a lot of words that not everyone might know what they mean. I always like to bring it down back into the basics. So, you know, we talk about asset allocation. We're basically talking about different tools that we have as financial advisors to create your asset allocation. So let's talk about some of those tools. So stocks and equities, Joy mentioned that. Jose was a stock equity kind of guy. He likes high risk. So stocks, what that means is as an investor, you are actually buying a very small portion or a large portion of a company that is publicly traded, which means, and let's think of an example like Amazon or Facebook or Zoom. Everyone's using Zoom today. It's a great investment to have. It's gone up extremely well in the last 12 months. So those stocks, they go up and they go down depending on the value of the company, depending on how it's performing, how their earnings are, if they've created a new technology. If we think about Apple, every time they come out with a new phone and it's successful, the value of that stock goes up. And every time they come out with a new tool that doesn't perform very well, it goes down. Leadership changes can affect those stocks. And then we have bonds. Bonds can be both government bonds and they can also be corporate bonds. This is where we see Monica's portfolio. It's stability. It's bonds are an interesting concept. So we're actually lending money to the government or to the corporation, and in return they pay us interest. So interest, it can be monthly, it could be quarterly, it could be annually. It's a regular payment, and the capital is typically protected, and you get full capital back plus all of the interest that you've made when the instrument expires. The next two are very similar. So mutual funds and exchange traded funds are baskets of stocks and bonds and instruments that have been put together by professionals that are called portfolio managers. Those portfolio managers, they make a lot of money. They're specialists in the funds that they focus on. You can buy a mutual fund that's a conservative fund, a balanced fund, an aggressive fund, or you can buy a mutual fund that is focused solely on emerging markets or small cap European companies. There's a lot of funds out there, ETFs and funds, probably over 200,000 in the world, and there's a lot of options. So it's really important to see the quality of the fund, the rating of the fund. Sometimes we worry about mutual funds because they do have a management expense ratio that can be a fee for management. It's a little bit high. Definitely a less expensive alternative is the exchange traded fund. So what's the difference between a mutual fund and an exchange traded fund or an ETF? Mutual funds are sold daily and by unit price, and ETFs are sold on the market at any given time. You can buy and sell when the market is open. Indexed funds actually follow indexes. They could be an index fund that follows the S&P 500 or any index that is available in the world. Currency is also an asset that we diversify inside of a portfolio for a client. It's common that people look for strong currencies like dollars, euros, or pounds to protect their investments from inflation and currency exchange. So what I've done on the right-hand side here is I've just kind of given you a graph to show you the difference between the risk and return, the standard deviation. Money markets, cash, government, treasury, investment grade, corporate bonds, they're lower risk. So the reward obviously is lower. And as we go up the curve, we see emerging markets, for example, equities that have a much higher potential return, but also have a higher rate of risk. So what do we do with all these things when we're building a portfolio? Ideally, we diversify. Diversification in portfolio really is that old theory about not putting all of your eggs in one basket. So when we talk about eggs, we're talking about the stocks, the bonds, the mutual funds, the equities and whatnot. And it's really important that we not only focus on the assets, but we also focus on other components. So the assets, we definitely want diversification. So if Monica is a conservative investor, for example, she wouldn't want a lot of equities in her portfolio. She may only want 10 or maybe 15%, whereas Jose would maybe want 80 or 90% equities. So asset diversification is determined by your risk and your time horizon. We also have sectoral diversification, and sectoral diversification is exactly what we would imagine it to be. It's sectors. It can be finance, it could be real estate, it could be health, really anything, it could be IT. And then we also have subsectors inside of that. So we also focus on geographic diversification. So you can have part of your portfolio that is stocks from Canada, or bonds from Canadian government, or from emerging markets, Europe, wherever. So diversification in geographics is really important. And you know, a lot of people say, well, I'll just invest in the US because that's the best market in the world. I might differ because I'm Canadian, but we don't just want to be in one geographic sector, because you know, if we look at what happened between October and December last year in the markets, there was turbulence and it was emotion. And it didn't really have to do, again, with something technical. And some of that actually didn't even have to do with COVID. It had to do with President Trump. You know, when he was going through his re-election, and there was uncertainty about how he was going to deal with the loss. Certainly everything that happened on Capitol Hill and then Biden's being accepted, that caused turbulence in the market as well. Short-term turbulence, but still turbulence. So that's why geographic diversification is also important. And then currency, same theory. Don't put all your eggs in one basket. Have diversification in currencies. We do know that currency is an investment strategy. Some people only have foreign exchange as part of their portfolio. So I've included a super simple example of diversification. I think it's fitting for Mexico. And it's just the difference between umbrellas and sunscreen. So portfolio diversification can be this simple. You know, here in Mexico, we have a rainy season, we have a sunny season. So we need an umbrella when it's raining and we need sunscreen when it's sunny. And those go up and down at different times of the year. So if you want to buy an umbrella and it's rainy season, it's going to cost you a little bit more, therefore there'll be more earnings. And if it's March break or vacation time and you need sunscreen, it's going to be more costly if it's in December or March. That diversification of having the umbrellas being more expensive than the sunscreen still gives us that medium line. And that's called negative correlation. So when we diversify all of these different types of assets, we look for negative correlation. When something is up, something is down. And it protects us from not having the same flow with all of our investments, so that everything doesn't go up and then everything goes down. I hope that helps. Does that make sense? Okay. So Joy, we've had a lot of funny conversations over the last year with our clients, fear-based questions, right? Tell me a little bit about what kind of advice you're giving to your clients about what do you do when the market drops?
Yeah, that's a great question. Well, markets are so unpredictable. Like, history can tell us how long dips and recovery have lasted, but it's not really an indicator for future dips and recoveries. And trying to time the markets does not work for that reason, because nobody's going to receive a calendar notice when a new dip will come and how long and big it will be. Those who will try to claim the markets, don't get me wrong, but they're lying. It's not true. The markets will always go up and down in value. Like, that's a fact. It's also a fact that financial markets will go up over time. And I mean, if we could perfectly try to time the markets, like, we wouldn't be giving this webinar, right? Like, we would be retired at the beach, probably drinking some cocktails, and yeah, so trying to market, it's not working. I mean, who would have expected to go into a global pandemic last year? Nobody would have expected that. Like, uh, it's a very good example from last year. Like, everybody experienced it. Markets dropped with 30% in some days in March. It just happened in 3 days. There was no time to adjust. Even if you wanted to, you're already too late. Nobody could have timed the market. And just as you mentioned, Shannon, like that fair, it wasn't based on technical data. No, it wasn't. It wasn't based on technical data. It was based on emotions. It was based on fear in the markets. It was based on uncertainty. Like, how long was this pandemic going to last? Like a week, a month, 6 months? Do I have to close my business? Like, nobody really was knowing, and still we don't. And so it was a very emotional time for investors, and what happened in the market was based on emotions. What we saw in the next 45 days is that some sectors recovered with 50%. And so people got confused. Like, they want to sell, as you can see right here in this graph. They want to buy, like when markets are doing very well. Like, markets are doing well, but that's actually when everything's already expensive. They want to sell when markets are doing poorly, when markets are doing badly. That's panic selling, and that makes total sense. Like, it's very understandable. Last year, a lot of my clients asked me, like, what should I do? Should I pull out? Should we change strategy? It's very understandable, and that's wrong. Like, I would say, like, what should I not do? So the very simple answer is, do not panic. Trust the process. Remind yourself of your goals. Remind yourself of your tolerance to risk. As said before, markets will go up over time. Long-term investors know that markets, they will rebound eventually. And so ride out the bumpy storm. And as you can read on the left, like, a smart investor does not try to time the markets, does not make emotional decisions, but stays consistent. So don't panic, and trust the process. Another way of making sure you're not trying to time the markets is dollar cost averaging. And dollar cost averaging is just a fancy word for investing in equal amounts in regular intervals. So that could be each month, each quarter, each half year. This is the perfect strategy for those who want to save on a regular basis, who want to save for the long term. Now, in this example, I have provided investor A. You can see right here, investor A has invested $1,000 in January. He can buy 40 shares of $25. Now, investor B invests $125 per month for 8 months. Because the share prices go up and go down, some months he's able to buy more shares, and some months he's able to buy less shares. And so at the end, investor B was able to buy 41 and 17 shares. And so he made 4.70% on his investment because he was able to buy shares on discount. Now, don't get me wrong. I'm not saying that a regular savings account is better than a lump sum contributed account, but this is just an example of how a regular savings account or dollar cost averaging can be beneficial to your portfolio. You're investing in down and up markets, and because of that, you're not trying to time the markets. You're also not trying to, or I wouldn't say not trying, you're less emotionally attached to your investments. It's what I mentioned before, the set it, forget it mindset. And so automatic savings that go to your financial future. It also helps you recognize that a market dip can actually be an opportunity and not a threat. So Shannon, I'll give the word back to you. You'll be talking us a little bit about volatility in markets.
Yeah, that's right. So we've heard the word a few times now in the presentation: volatility, turbulence, down markets. What does that word really mean? So I think in my personal opinion, volatility sometimes gets a bad rap, you know, it gets a bad reputation. And so I found this really great little video. I think it explains volatility in a very positive way. I'm going to show that to you guys now.
Volatility in simple terms. Volatility is an up and down market movement. Let's assume you expect a stock to be at one price, but over a short period it drastically goes up or down. Calculated as a standard deviation from the expectation, such movements reflect volatility. If a position goes through remarkable changes in value, we call this position highly volatile. Vice versa, low volatility means the position is stable. High volatility brings uncertainty and scares people. At the same time, highly volatile positions can generate much profit if you're willing to take the risk. How to determine the stock volatility? Trace the trend. Remember that volatility equals swings. Look at the volatility index chart and analyze the severity of a stock market price fluctuation. The more violent are the ups and downs of a stock, the more volatile it is. Volatility helps you realize whether a stock fits your portfolio or not. It's up to you to decide whether to take an extreme ride or an easy slide. Good luck.
I think that kind of gives us a better understanding of what volatility does. Volatility gives us opportunity. So when markets are down, I have an expression I use all the time. It's like buying in El Buen Fin. You know, you get everything on discount. And I love everything on sale. So volatility, although it's usually attached to emotion, if you really do question your feelings about investing during down markets and you have cash available, it can be a really great opportunity for your portfolio. So what I want to do now is, we're coming up to the end of the webinar. There is a question and answer section where you can actually go in and type. You can type questions for us and we will be happy to answer them for you. This is the last part about the do's and don'ts and about handling turbulent markets. So we talked about this at the very beginning. Let's just say it. Stick to your strategy. You've built it. You got professional help. You've set your goals. You've determined what your short-term goals are, your medium-term goals, and your long-term goals. And you've allocated your savings. So, you know, you have to be confident in your decision and the advice that you've got and received about those strategies. Implement the dollar cost averaging. Joy gave us a great explanation about what that means. And dollar cost averaging is applied to regular savings, but it's also applied to the way that we purchase stocks. We don't necessarily just jump into buying 100 stocks of one company. We can actually purchase stocks at different times in the same company to dollar cost average. Invest in both bull and bear markets. So don't be afraid to set it and forget it, just like Joy says. Make sure that that you're conscious that, you know, if you've got a regular set of funds that are available on a monthly basis, that you're continuously trying to put money into the market and grow your portfolio so that you reach your goals. And diversify your portfolios. So diversification, once again, you know, it's stocks, it's bonds, it's currency. You're talking about diversification geographically. There's so many ways to diversify your portfolio. The more diversified you are, the better off you'll be. I love giving the example of horse racing. So I live close to El Hipódromo here in Mexico City, and I'm probably the worst person to take to the horse track, because some of my friends might go in there and they'll just buy one horse because they know the horses, they know the jockeys, they know the genetics of the horse, and they'll say, you know, Sugar Daddy's gonna win the race because he's the best horse in Mexico. I'm the kind of girl that if there's 24 horses, I'll buy 12 because I don't like to lose. I like diversification. We don't know if Sugar Daddy's gonna hurt his foot coming out of the gate. I'd rather win a little bit than win nothing or win it all. So diversification in your portfolio is exactly the same. So don't get emotional about bear markets. I showed you the chart. The history doesn't lie. I mean, there's no guarantee that there's not going to be another downturn in the market in the future. We're still going through turbulent times right now. But when you sell because of emotion and not because of logic, you're typically making a bad decision. So if you're concerned about your portfolio, we did ask you, you know, how are you feeling about your portfolio? How are you feeling about your asset allocation? Is it time to review? Now is a good time to review. A year ago was a time to review. If you've had major life changes or your goals have changed, always go for your review, but don't sell because of emotion. And then don't wait for perfect timing. Always be buying is, I probably, if I was going to have a tattoo, it would say that. Just always be buying, always be investing. Don't wait. We don't know when the perfect moment is in the market, and trust your plan. So I hope that's been helpful for you. I hope that you were able to take some information away that you can implement in your financial plan, and to look at your strategy for asset allocation. We are certainly happy to help. We do recommend that you sit down with your financial advisor and have a discussion. So at this point, I'm going to open up the question and answers. And if you have some, there is a little icon there that says Q&A, and you can type in your questions there and we'll be happy to answer them. I do see that we have a couple of questions now, so just let me click into them here. Okay, hello. Okay, so we've got a question here about a conservative investment. So what is a conservative investment average return? Okay, so I think when we're talking about a conservative investment, if you recall when I mentioned bonds have an inverse relationship to interest rates and what's happening in the economy, obviously. So conservative investments typically produce a 3 to 5%, could be a little bit more, but typically conservative is 3 to 5%. Conservative is really about capital protection. So we're not taking a lot of risk. And so I would say that's fair. Now I am talking about a dollar account, not a dollarized account, a dollar account.
I see, Sarah. I think this was great. I do have to run, but it was clear, well presented, and helpful. Thank you, Jose. Very nice. I see another question. What is the right amount for me to start investing? Well, that's a good question. And it actually depends on your capabilities. So sit down with a financial advisor, look at your options. Maybe it's more comfortable for you to save something on a regular basis. Maybe it's sending it away at once. So depending on your capabilities and what kind of type of account you're looking for, there might be there will be a fit for you for sure.
Yeah. So I have a question here from Enrique, and he's asking, do we recommend investing in Bitcoin? So listen, I love investing, and I like all types of investing. I like venture stocks, for example. So I like a little bit of risk. I don't have a fear of Bitcoin or any type of Bitcoin or other types of vehicles like that. I just think that the fear that I have at this point is it's still not completely regulated. So it is a little bit of a wild west. Now there's a lot of money going on and there's a lot of speculation about Bitcoin, but all investments start somewhere. So if you want it in your portfolio, what you have to do is you have to link it back to what is your risk tolerance. I would never recommend taking your entire portfolio of your retirement and putting it into Bitcoin at this point, but it's completely up to you. At the end of the day, the investor has the last word. My recommendation is that we wait a little bit longer in order to jump in whole, both feet into the pond. So let's see what else we've got here. I'm about to retire. What percentage will you recommend to put into bonds and equities? So I think when we talk about retirement, we talk about capital protection, that depending on how much money you need to use from that retirement fund right away will indicate actually how much, like what percentage of money you need to take out on a monthly or quarterly basis to support your retirement. So bonds don't produce a lot of income. If you require a higher percentage of growth, you may need to take a little bit of a risk. But typically, just before you go into retirement, capital protection type of strategy, conservative type of strategy, you're typically looking at, you know, a 70 to 80% fixed income to equities. You still want a little bit of growth, but you don't want to put it all at risk. You want to take another question here, Joy?
Let me see. I see a question here. I saw a question from Manuel. Is it, how about investing on commodities, indexes, or fins right now? It's expected to be bull markets for them.
Mm-hmm.
Investing in funds and indexes is always a good idea. So definitely right time to start investing in those kind of instruments.
Okay. So what industries are you expecting to grow in the US and Mexico, and what are the risks that you worry about most? So I have to declare, Rodrigo, is I don't actually invest in the Mexican market. I'm exclusively zoned to international investment accounts. So I can't give you an opinion, honestly, about Mexico. I will say that my current opinion about the US is that it's a little overpriced. I'm not spending a huge percentage of my equities in that market right now. I am looking at other markets like Europe and emerging markets and some markets in Asia. I still think that there's some opportunity for correction in those markets, but you know, it's hard to speculate. But I would say that's probably that's a position that we're holding right now. So I don't want to keep everybody long here. What I will try and do is I'll answer some of the questions that we're repeating here. I do want to say thank you very much for your time and your questions. It's a pleasure for us to present. We always enjoy doing webinars for our clients and hoping that we're passing on a little bit of education. At Kempton Asset Management, we are so dedicated to delivering exceptional asset management to our clients, and we look forward to hearing from you. If you'd like further information from either myself or Joy, our contact information is here. You can certainly take a photo of that and just give us a ring. And that's it for now. So everybody stay safe. We'll see you soon, and we look forward to hearing from you. Take care.
Thank you. I wanted to give a quick shout out to Arlie, who helped us setting up the presentation.
Yeah, thank you very much.
Yeah.
Have a good night.